Hi guys, my name is Kuda. Welcome back once again. Today I'm here to talk to you guys about how to trade chart patterns like a pro. Now the biggest problem that we have is that a lot of the pro traders aren't really available online to give you guys good trading tips or give you proven trading techniques. So what happens is most newbies tend to fall into this trap where they just absorb any information that's online. And I can tell you right now, 90% of all information available online about chart patterns is completely wrong. Now, I don't mean, when I say, let me explain what I mean by wrong. I don't mean that when they show you a wedge, that it's not a wedge. But the technique around trading it is totally off. Because trading, the one thing you must remember is that it's all about entry points, stop loss, and take profit. So if your entry points are off, because you're trading on the breakout of a pattern, for instance, that's the end of your game, man. That's the end of your game. So today I want to talk to you guys about chart patterns, how to trade them like a pro. There are over 12 patterns. I'm going to explain 3 of them, and stay tuned. Alright, so let's look at the board here. This is your conventional bullish flag. Alright, so you've got your flagpole here. If that's 100 pips, what we know about flagpoles is that the extension of the leg from here to there is also going to be 100 pips. That's normal. That's available online. It's free. What you hear online though is that you should trade the break of the pattern. So we'll take this pattern, we do that, and then you're advised to trade the break. Your entry point must be above the break. This is totally incorrect. You trade like this over time, you will not make money. You will not make money. Why? A lot of things happen around this zone. You get a breakout, price breaks, yeah, you're in profit, it comes back for a retest. You can spend a week there, right? Before continuing to the take profit target. This zone depletes your psychological capital. I think a lot of people don't understand what psychological capital is, or PsyCap. PsyCap is, you've got trading capital in your trading account. You also have psychological capital. This means your waiting game, your ability to wait out a trade till it gets to profit must not be compromised. Because if you spend too much time here, you're gonna get naturally exhausted, and you find yourself taking profit there, or taking profit here, or closing the trade at break even. What you want to do when you're trading like a pro is you want to always be ahead of things. So when the markets make the first touch, the second touch, the third touch, this is where you want to be looking to place your entry. Your stop loss below the previous wicks, that's a good zone to put your stop loss there, and your take profit target, the extension of the leg. Now notice what happens here. The price can break out, retest, but you're already in profit because you entered early. You understand? So because of this, your psychological capital is not depleted. You are strong, you're seeing profits in your account, you're firmly in the blue, you're able to wait for this price to make it a TP. That's the first thing. The second thing is around risk reward. Your risk was here, this is your risk reward. This is your risk, your entry and your stop loss. This represents your risk. So if the price falls and comes down to your stop loss, that's how much you're risking. Your reward is the distance from entry to take profit. That's how much you're making. Anytime the price is above your entry, you're in profit. You're in profit, you're in profit, you're in profit, you're in profit, you're in profit. Notice the risk is small, the reward is bigger. In this instance, you're dealing with about a risk reward of 1:10, which I'm going to show you on my computer right now. This is where you want to operate as a trader, because you don't need to be correct more than 30% of the time when your risk reward is 1:10. Here, in this instance, your entry is here, your stop loss is here, all right? So that's your entry, that's your stop loss, and that's your take profit. You will notice that now this region represents your risk, and that region represents your reward. In this instance, your risk reward can be 1:2, or even as low as 1:1, which means here, if you're risking $100, if you hit take profit, you make 1,000. In this instance, if you're risking 100, if you reach take profit, you're making only 200. This is an unsustainable way to trade, guys. You have to understand this. So what I'm trying to show you here is the difference between the pro trader's technique and the beginner internet guru. You're just starting to trade right now. This is the wrong way to trade. Yet this is what's flaunted and advertised online. So yeah, let's move on to my computer so I can show you how this plays into your trading plan and how you want to always be operating here. Hi guys, so let's get straight into it. This is the chart patterns masterclass, and we're going to be going through patterns. Today we're going to be focusing on bullish and bearish flags. And before we get started, you can always download these free ebooks. They're available on www.kuda.trading or www.tradersupport.network. Alright, so let's get started. The challenge faced by many new traders is where to find proven, factual, and credible trading content that actually delivers. The pro traders of this world are too busy actually giving away proven trading techniques, or to give away their proven trading techniques. And what happens, guys, is that most of the stuff that you're finding online concerning patterns, concerning how to trade them, is absolutely wrong. You will not make money because the techniques being shown or demonstrated to you don't actually yield results over time. They're not proven money-making techniques. So you need to, at this point in time, I think the purpose of this ebook is to really demonstrate to you how pro traders are trading chart patterns. And the sooner you get to trade that way, the sooner and faster you'll see results actually. So I wrote this book rather reluctantly because it puts me in that internet guru category, which I'm trying to avoid, and I've been trying to avoid my whole life. But if you want to know more about me, here's some things that could interest you. A few things about me. I started trading when I was 19 years old. That's 15 years ago. So I've been trading for 15 years now. I make an average of between $20,000 to $50,000 a month. I actually built a school and built 3 more. So I built a school in 2016. You guys can view my profile on www.kuda.trading. And I've trained over 15,000 people throughout Africa. I'm a verified trainer for the Zimbabwe Stock Exchange. I've written 2 books and all the flashy things that traders like. You can always see that on my Instagram. We've been there, done that. So let's dive straight into what are chart patterns. So chart pattern is a shape within a price that helps to suggest what price might do next based on what the chart pattern has done in the past, right? So chart patterns are the basis of technical analysis. They cannot be ignored. Chart patterns are used by professional traders and hedge funds every day. So one thing is certain is that they cannot be ignored. You cannot ignore a double top. You cannot ignore a double bottom. You cannot ignore a head and shoulders, an inverted head and shoulders, a rising wedge, a falling wedge. Those are known as bullish and bearish, bull and bear traps, etc. You can't ignore that, and those are manifested or visible in the form of a chart pattern. So the best way I can explain this, and I've done this in this ebook if you download it, is I'm going to show you the pattern. I'm going to show you how the pro traders recommend you trade it, and what the internet wisdom or internet gurus say you should trade. Right, so you'll be able to see the difference between the 2 techniques, and I'm sure if you catch on to it, you would definitely see a massive improvement in your trading results. So there are 3 types of trading patterns or chart patterns. There are trend continuation patterns, trend reversal patterns, and bilateral patterns. So in order to understand what chart patterns are and what causes them, you need to understand consolidation, guys. You need to understand what consolidation is. So this is what consolidation is. I'm going to jump straight to a chart. When the markets move, when the markets make an aggressive move in any direction, up or down, right? So in this instance, we're going to talk about bullish flags. So I'm going to be talking about the market making bullish moves or aggressive moves in an upward direction. When the market makes an upward aggressive move, it has to pause, it rests, it consolidates. So consolidation is known as a brief pause in market price movement, right? And that brief pause, during that brief pause, a pattern is formed. This pattern is what gives us an indication as to what the market is going to do next. So the market here was moving aggressively. It pauses, appears to go sideways, right? And then we see a flag forming here, right? So a flag, remember, a flag has got a flagpole. That's a flagpole. All flags rest on a pole. Then that would be typically your flag, right? So that's the market making an aggressive move up and then consolidating within support and resistance. This is resistance and that's support, and these lines must be perfectly drawn because they have to be parallel, but more on that later. If you see this is an indication that the market, after it's finished consolidating, is going to break out to the upside and continue to go up. So this is where we get the trend continuation patterns, right? These are patterns that after consolidation, the market will continue to go in the direction it came from. Yes, right. And then if you see here again, the market goes up, consolidates. This is a slight retracement, right? This probably is a 31% retracement. So it retraces slightly and then continues to go up, right? So this is the flagpole, and that's the flagpole's extension. And then after it goes up, it retraces again. Notice that this line here is perfectly parallel to that line. Okay. Then after consolidation, because it's a flag, we know that the market is going to break out and continue to go in an upward direction. So this market, this is the euro dollar chart, and we'll show you from April 2017 all the way through to April 2018. The euro dollar was very bullish, and what was helping sustain that bullish momentum were a series of these bullish flags, right? So that is what you need to know and understand about consolidation. So whenever consolidation happens, expect to see a pattern that will indicate where the price will go up or down or reverse. Okay, I've just shown you this. This is the same euro dollar chart. The yellow blocks are what are indicating the, or showing us the consolidation periods. Now what you want to know about flags, so the trend continuation patterns that you should know are bullish and bearish flags, bullish and bearish tenants, cup and handle, falling and rising wedges in a trend. Now I'm going to focus more on bullish and bearish flags today. We won't have enough time to cover all the trend continuation patterns, but remember, in order for you to draw these and identify them properly, you need to understand what support and resistance is, and you need to be able to draw your trend lines correctly, guys. Come on, this is so important. A lot of people draw trend lines incorrectly. They'll be cutting through wicks, and oh my goodness, that's just the worst thing you can do, because if you have to force the trend line to fit, it's never a good idea. Okay, you can download this ebook. Like I said, jump onto it. You'll find it on Kuda.trading, or better yet, you can find it on www.tradersupport.network. Now, tradersupport.network is a website that is designed to assist traders, where trading setups are given daily, trading setups of signals which are detailed and well explained. It's a community of over 5,000 traders coming together to share setups, serious pro traders. So if you want to be part of that, I suggest you go and visit that website, and when you do, you'll be able to access this content for free, right? So there's a free package and there's also a subscription package there. So what do you need to know about bullish and bearish flags? I'm going to go to the board shortly to show you this, but I'm going to also explain it here in the meantime. Let's go. In all my years of trading, this particular pattern actually has really done quite well for me, because it's pretty predictable. Bit rare to find, but very predictable. I was able to do quite a lot with it personally in my own life. So I'm just going to dive through to the things that you need to know about flags, about bullish and bearish flags. They all have a flagpole. Now, what is a flagpole? A flag pattern is when a flag pattern is emerging, you will note a large impulse move in one direction or in an upward direction. I think I showed you this. Like, you'll see this big impulse move there, right? What you then note is that the flagpole will consist of a lot of bullish candles, green candles. You see those green candles, a lot of them lined up in a row. Sometimes you get your three marching soldiers there, but it's just basically bullish action going in an upward direction, right? The flagpole consists of a lot of bullish candlesticks, and in particular, There's 3 marching soldiers, or some bullish engulfing candlesticks formations. You measure the distance of the flagpole by measuring the distance in pips from the point where the impulse move starts to when it stops. So in this instance here, the impulse move starts there, right there. That's where the impulse move starts. So our flagpole is also going to start there. Where it ends is up here, right? Okay, so you connect a line, you draw a line, and the extension of the flagpole is simply going to be you copying this line, right? And starting from there to there, that's where the extension of that bullish move will continue. So there's a flagpole and there's a flagpole extension. So that's why you see here there's a initial flagpole and then there's extension. The extension is where you want to place your take profit target. This is where you are going to be looking to exit, right? Once you enter the trade to go long. Simple enough? I hope so. Right, and then the flag is actually the consolidation that happens after that extension. So after the strong bullish move, price will pause and rest, and this is known as consolidation. I've just explained this to you, right? And this pause is a minor reversal in the direction of price as though it were going backwards. That's known as a retracement or pullback. You can measure these pretty well using your fibs or your Fibonacci extensions. More on that later. If you subscribe to my channel, I've got a lot of videos that I'm going to be posting to cover this. So in simple terms, that's the flagpole, that's the flag, that's the consolidation period. You see there's a slight dip backwards, that's your retracement, and then you get your extension. That's when the market breaks out and continues, trend continuation, remember, continues to go up. Right, entry rules as advised by the internet gurus. Hey. This is how beginners advise to trade bullish flags. It appears logical, but in reality it will not lead or yield consistency in your trading. So let me show you what I mean. You see this flag here, right? And you get that consolidation period. What you're advised to do on the internet is to place a trade above the break or above this resistance. And that's when you should place your entry, and you should place your stop loss below the previous lows. And the distance between entry and stop loss is what's known as your risk, right? That's your risk. So entry, if your price goes down to, if the price goes down to your stop loss, you lose money. Let's assume you're going to lose $100 because you set your stop loss value to $100. Your risk in this trade is 100. Your reward is the distance between your entry and your take profit, which is determined by where the flagpole extension ends, which is right there, right? This is how you're advised to trade this pattern online. It sounds pretty logical actually, but trust me, over time it will and does not work. I'll explain to you why. So let me just prove to you. I've got some searches lined up here. This, if you just look here, how to trade a bull flag online, you will see that, and you know, sod's law, the internet is actually being so slow. I guess maybe I'm not supposed to show you that, right? Right, there we go with the flags. So you'll see that the internet conventional wisdom is that you're supposed to place this trade. Let me just dive through. You're supposed to place entry. Do you see that flagpole there? You're supposed to place your entry above the break, right? That's all the advice that you're getting, that you're supposed to be placing your entry above the break, right? Supposed to be placing your entry above the break, and this is what you'd be advised to do online. And I advise you, this is the conventional wisdom. This is what you're told to do online, and it's exactly what you should not do. It's exactly what you should not do, right? So let me explain to you why. Here's why trading this way will not work in the long run. Retests. Oh man, if you've ever traded before, you definitely have come across this. As you can see from the yellow block, you see there's a yellow block here. The market breaks out and then comes back and retests that resistance. That retest of the resistance depletes your psychological capital. A lot of people are obsessed with trading capital and you ignore PSYCAP, right? PSYCAP, psychological capital. It's when the market pulls back and puts you back in a loss, and now you're stuck in this position or in this zone, right, for a week. Yes, and now you're exiting early. You're confused. You're totally drained and tired. That's the first reason why you shouldn't trade the break, because of retests, right? The risk reward ratio is not favorable. In this particular example, it's about 1:2. In other words, the risk, remember, is the distance between entry and stop loss. If that's 100 pips, or in that distance there divided into this distance is about 2 times. So if that's 100, if you're risking $100, you're going to make 200 if it makes it if the price makes it your take profit. That's not enough. You cannot trade to only make twice as much or to make an RR of 1:2. I'll show you why. It's all mathematical. I've come here and I've got a trading plan, and you can get these trading plans again, guys, on the Trader Support Network. We've got these lined up for you. You can download these templates. You need to have a trading plan. Oh my goodness. If you want to see an improvement in your trading, you've got to structure it. You've got to treat it like you've got to trade like a pro. Treat your trading like a pro. So let me continue. The balance here is $1,000. That's the balance in your trading account. Your risk is 5%. In other words, you've told yourself you want to risk 5% of whatever's in your account. And if you target to only make an RR of 1:2, in other words, you are placing these typical setups where you are trading on the break of the pattern, or the break of the support, or the break of the resistance, right? What you're going to get is an average RR of 2. So let's plan this out. If you're going to place 20 trades, so this trading plan is just a plan. It's not what really happens in real life, but it's a plan. So you say you're planning to place 20 trades. Of those 20 trades, 13 of them will be incorrect. That's the red column. And 7 of them will be correct. So your win rate is going to be 35% in this example, right? And then your first trade, you risk $50, which is 5% of 1,000. Remember, 5% of 1,000, right? So you're risking $50, and boom, it's a loser, right? You don't really know the distribution of your winners and your losers, but what you're saying is, I'm just going to randomly apportion winners and losers. I'm going to prepare to be wrong 13 times out of 20 trades. It's a plan, okay? And your first trade, you're planning for it to be correct, so it means you're planning to have a new account balance of $950. Your second trade is going to be $47.50 is your new risk, which is $950 times or multiplied by 5%. So your risk on your next trade is $47.50. You're wrong on that trade. Your new balance is 902, which means your drawdown is now down to 10%. You have lost 10% of your account. Now, if you, for some reason, your third trade is this particular setup, you enter this trade, boom, you enter it, you place your stop loss there, you place your take profit there. This trade is going to give you an RR of 1:2, right? A risk reward ratio of 1:2. Now, if you take that and that trade works for you, right, you're going to make a profit of $90. The result is a $90 profit, which brings your balance up to $992, right? Now, let's assume you get all these 1:2 trade setups, and you get 7 of them, and you get 13 trades incorrect. You're going to end up with a balance of $1,000. Basically, you're going to be back where you started because you're taking these setups on the break. You're entering too late. So your risk is too high, all right, vis-a-vis your reward. So let's change that scenario a little bit. Let's go and keeping the same assumptions there, 13 trades wrong, 7 trades correct, a win rate of 35%. Let's change the RR to 10. Okay, if you're a pro trader, you know what I'm talking about. 10 is what we shoot for. 10 is the magic number. Now, see what happens in this instance. Your balance will end up being $8,770. Your profit will be $7,770. Right? The same amount, same setups, but a greater reward. Even if you change this to 3, right? You get 1,365. This is where beginners should typically be stuck with targeting RRs of 3. If you join the Trader Support Network, tradersupport.network, we give you setups, and we've got a community of expert contributors that give setups that are supposed to give an RR of 5 at a minimum. So if you get that, at least you'll be doubling your account if you pick those setups, and if they're only working 35% of the time. So let's punch back 2 so you can see that. See, we go back to the $1,000 we're talking about. So risk reward ratio is everything in trading. It is absolutely crucial. Guys, you've got to make sure you pick setups that give you a good reward. Now you're wondering, why can't I just be right all the time? Why is your win rate so low? If you're a good trader, why are you only correct 35% of the time? Because you can't be correct 90% of the time. It's a myth. Those are scams. It doesn't happen in trading. You have to figure out how to make money being correct only 20 to 30% of the time. If you are correct 70% of the time, that's just luck. That's luck. Thank you, lucky stars. But don't expect to do that consistently. So you have to figure out how to make money just being correct 20 to 30% of the time. That's what matters. So I've downloaded this PDF by Jack Schwager. In it, he's interviewing one of the great gurus of Forex market back then. And if you just read this, he says, so he's asking this trader, do you believe your scaling type of approach in entering and exiting positions is essential element to overall success? This is a guy that made $200 million in a day, so let's hear what he's got to say, right? You have to be able to let your profits run. I don't think you can consistently be a winning trader if you're banking on being right more than 50% of the time. You have to figure out how to make money being right only 20 to 30% of the time. This is what traders don't want to hear. Traders want to be right all the time. That's all you guys want. You just want to make money all the time. Every trade must work. That is not trading. That is not the truth of what happens when you're a trader. When you're a trader, you have to figure out how to make money being correct only 20 to 30% of the time. So I wanted to show you a part here where it talks about how he made 200 M's, 200 million, all that stuff. Can't find it, but I suggest you download this anyway, and and see if you can find just read this, read what other professional traders are trying to do. These books have helped me. It's like the Bible for traders. It really helps us manage our assumptions and not get extra greedy. So I can't find it there, but hey, I think you get the point, right? So let's go back to the ebook. That I wrote. There we go. So as a trader, how do you get that RR of 1 to 10? You're probably wondering, right? How do you get the RR of 1 to 10? This is what you have to do. You have to use what are known as edge point entries on your patterns, guys. This is what you do. The same pattern I've shown you up here. I've just pulled. In fact, we can actually do this from the ebook. Here it is. Right, you need to place your entry on the support of the flag. After it's made its third touch, 1, 2, 3, you have to be looking to place entry here, stop loss slightly below. Now the orange bar, that's your risk now. So that's your entry, your stop loss is here, and look at just how small that risk is in relation to your reward, right? You'll find that if you divide this distance into that distance, this distance into that distance, it'll go in about 9 times. So your RR is a 9 in this instance. The same pattern. The only difference is you've taken entry early. Alright, you've taken entry on the support. I call this edge point trading, and I've trained a lot of people how to do this, and they're making money. So if you punch in 9 here and you look for setups that have got edge, where you're trading with edge, right? Look at that, you end up with $6,918. That's a profit of $5,918. So you've got to look for setups where you can make entry early. Now, the question most people have is, how do I know it's going to reverse? How do I know it's about to go up? You usually work with the 3 things, the 3-touch rule, or you can add your fibs, right? You can add your fib retracement. As you can see here, if I put my fib, I'm sitting smack bang on 50% retracement, right? So you can use your fib levels. If you don't know how to do that, just watch my GoPro or my masterclass videos on how to use fibs and incorporate them into your patterns. That allows you a zone. It gives you a zone, an indication of where you should be looking to place your entry to go long. Now look at that. Isn't that beautiful? Your stop loss below that previous wick there, and your entry here. Let's now count or measure the risk reward. Your risk in pips is exactly 100 pips or 1,000 points, as you can see it there. Your reward, oh my goodness, is 944 pips. So that's 9 times as much, right? That's just what you need to do, guys. This is what you need to do. Is what you need to be learning. That difference. So you're going online, and what are you getting? Enter on the break. Don't enter on the break. Look to enter slightly below the break. Okay. Here's what happens. You're saying, okay, why is your stop loss so tight in this example? I'll tell you why it's so tight. Because if the price breaks below this point, then it's no longer a flag. You are wrong. You don't need to stay in that trade for much longer. It's over. Take the loss, walk away. That's why it's so important to draw this line accurately, right? So you put your stop loss slightly below that. It's fine. You take the loss, you take the loss. In this instance, if you risked $100, right? If your stop loss is equivalent to $100, and you held the trade, you'd have made $900. And guess what? Your side cap would still be strong, because the moment you enter, you're in profit. Even if the price retraces, you're already in profit by the time the price is here. You're probably in a profit of $200 to $300. So you can actually make the full extension. You can make the run. And remember, the advice that came from the gurus, the real gurus, not like the internet gurus, right? The real gurus, the real advice that came through there was, let me jump to that page. Just get to that page. I probably should edit this out, yeah? Is that he says, I think this has enabled me to stay with long-term winners much longer than I've seen most traders stay with their positions. I don't have a problem letting my profits run, which many traders do. If you want to let your profits run, this means from here to there, you're letting your profits run. You're letting the markets continue to give you profit, even if they're retracing. It's fine. The only way you can survive that run is if your psychological capital is intact. That means you're psychologically strong. You're feeling good about the trade. You're in profit almost as soon as you enter the trade. This gives you good psych cap and allows you, the willpower to make the run. Okay. Is there anything else I want to show you? I don't think so. So, guys, if that was helpful, please subscribe. There are a lot of chart patterns. You can download this ebook. It's for free on the Trader Support Network website. Download this ebook. I do go through a lot of other patterns as well, right? Bearish pennants, bullish pennants, symmetrical triangles, and all of these patterns have got a particular approach or technique that you should use to extract the highest reward. All right, so yeah, catch you on my channel, guys. Cheers.